Hello, and welcome to this month's View from the Lighthouse. I am David Hansford, Executive Director and Portfolio Manager at Long Beach Capital. This month we are talking about the war in Iran, the oil price, and the opportunity in growth and technology shares. The US and Iran announced a fragile ceasefire on Tuesday, April 8th, shortly before Trump's deadline, and outrageous threats expired. After a failed first round of negotiations in Islamabad, Trump instituted a blockade of Iran's closure of the Strait of Hormuz, and this week Trump extended the ceasefire, while the US and Iran attempt to find common ground to restart negotiations. Logic should dictate a negotiated solution to a conflict in which neither side is likely to prevail by force. Trump entered the US into war with Iran without clearly stated aims and objectives, or buy-in from Congress, the US public, or allies. After the initial bombardment and decapitation of the Iran regime through the assassination of Ayatollah Khamenei failed to lead to regime change, Trump was left without a clear strategy or plan B. Iran demonstrated resilience, a clear decentralized strategy for the war, and held significant leverage by closing the Strait of Hormuz, through which 1/5 of the world's oil and gas exports flow. Israel's war aims may well have been different from the US's aims, but the decisions to start and now also to end the war belong to Trump. It is not clear Trump has achieved anything through this war. Iran is certain to exercise greater control over the Strait of Hormuz in the future, and the Iran regime remains firmly entrenched. The US's relationships with allies have been frayed, and at the least a greater degree of circumspection will exist in any future diplomatic dealings with the US. The US's enemies and strategic adversaries will welcome the degrading of expensive and hard-to-replace US military hardware, not to mention the significant loss of trust and soft power with more neutral countries. Potential war with Iran has been an outlier or black swan event for markets for a long time, and while there may well be a resumption of kinetic hostilities, both Trump and the Iranian regime should be highly incentivized to find a resolution. Significant rebuilding will be required in the region, both in Iran and the Gulf countries affected by the war, economically and in terms of destruction of physical infrastructure. This will require significant funds, with oil and gas the most likely sources of revenue. At the same time, the conflict provides further incentives for the shift towards renewables and alternative energy sources. A long-term bear market in oil prices may well be a likely outcome from the conflict. The US economy is likely best placed to weather the impact of higher energy prices in the short term. The US is a net energy exporter, has a flexible economy, and is furthest ahead in terms of AI investment. Higher energy prices are also positive for US terms of trade, and the US dollar is likely to be supported in the short term. The US is likely to be an early beneficiary of the productivity benefits from AI due to the scale of AI investment in the country. Inflationary impacts from current elevated energy prices are likely to be felt more by energy importing countries with less flexible economies and by countries slow to invest in AI. In the last 5 years, the global economy has experienced a number of major shocks, a global pandemic, and 2 large-scale wars. Through this period, the global economy has demonstrated resilience and adaptability, with technological innovation continuing at breakneck speed. From GLP-1 weight loss drugs, AI, electric vehicles and autonomous mobility, robotics, satellite communications, and innumerable other small and large transformative innovations. As an investor, it's always worth looking beyond the negativity of headlines and short-term events, and remembering the global economy has very significant incentives towards positive outcomes for individuals and society. Global equity markets have recovered off the March lows, but the opportunity created by the sell-off in growth and technology remains. Growth and technology shares currently offer attractive valuations, strong earnings growth, and attractive long-term prospects. We expect favorable conditions for corporate earnings and equity markets through the balance of this year. The Long Beach funds are invested in innovative, well-managed growth businesses, which are aggressively exploiting AI, and have substantial data advantages and extensive customer relationships. We are encouraged for the future potential returns from our holdings in the Long Beach portfolios. Thank you for listening, and join me again next month for another view from the lighthouse.